Hello, everyone. Hi. So Elena gave me the unenviable task of tearing you away from the first chance to chat away from the room. So thank you, Elena. I think we'll want to try to get started on time. We're excited to have our second session on stablecoins. And it will begin with Mattia Landoni from Federal Reserve Bank of Boston, presenting a paper and discussed by Federico Greenberg from the IMF, followed by Sharon Ross from Federal Reserve Board, discussed by Scott Hsu from West Virginia University. So, floor is yours.
All right, good morning, everyone. And I would like to thank the organizers for organizing this incredible conference with this very interesting program. Our paper is about stablecoins. Several of us were really into stablecoins and crypto, and several others of us were really into money market funds. And we have heard it's sort of part of the zeitgeist, this idea that money market, that stable coins are awfully similar to money market funds in several ways. So we've tried to see essentially how far we can push this metaphor and how similar they really are in the features that we're interested in, which is runs. I work in financial stability, so there are many other interesting things, but this is one of them that touches directly upon my work. So let's begin with some motivation. Why are we interested in stable coins? As you see in the top right chart, the market capitalization of stable coins has been rising has risen very quickly in the space of 2 years to about $200 billion. It has reduced somewhat, especially since interest rates have risen, but perhaps also for other reasons, but not so much as you would imagine, right? We can perhaps confidently say that stable coins are not only a low interest rate phenomenon at this point. And there have been, however, many stresses, many stress periods. There have been runs, there have been collapses. And stable coins have another really important characteristic, unlike, say, true cryptocurrencies such as Bitcoin or Ethereum, that they are, many of them at least, are backed by traditional finance assets. So if you take, for example, USD coin, which is one of the largest and most famous ones, it is a token that tries to have a constant price of $1. You surrender $1 in cash to the organization somehow, and they give you one token worth $1. They will take your dollar, they will invest it in treasury bonds, bank deposits, and other traditional finance assets. And with these reserve fund, they essentially back the value of the tokens one for one, right? And so if there were a large outflow out of USD coin, as there have been in the past, you would have that the USD coin reserve fund would have to sell a very large amount of assets, of traditional finance assets. And now we have created a link between the crypto world and the traditional finance world. Before I continue, I would like to say that what I said and what I'm about to say does not necessarily represent The rule is not that the disclaimer has to be in the beginning, it just has to be prominent, I believe, and this is very prominent. Does not represent necessarily the views of the Federal Reserve Bank of Boston, New York, or the Federal Reserve System. Now, there are, again, similarities between money market funds and stable coins that we're going to explore. And the stable coins have been in the news many times, both in terms of the newsworthy episodes that they have caused, as well as for their similarity to money market funds and for their link to the real economy. In recent stress periods, we have seen that money market funds experienced flights to safety. Let me define flight to safety. Flight to safety is an outflow from funds that are perceived as risky to other funds that are perceived as safer. The alternative to you could have a run without a flight to safety, to be clear, right? The money would leave the platform and never come back. But there could also be a flight to safety where at least some of the money remains on the platform, goes into a different product that is perceived to be safer. In the money market fund space, there are two types. There are more than two types of funds, but generally speaking, you could distinguish between government funds that hold government securities and prime funds that hold a broader range of securities, including some created by the private sector, such as commercial paper, etc. Stablecoins being the rough equivalent of money market funds in the crypto world, and we will talk about similarities and differences in a second, they perhaps are subject to some of the same issues. One issue with money market funds that makes them somewhat runnable is that they will reimburse you for the money you deposited at par, right? So if the value of the fund's assets drop below $100 or 100 cents on the dollar, let's say they go to 99 cents and there are 100 investors, each one of them could redeem at par at $1. The first 99 investors would get their money back in full, and the 100th investor to show up at the door asking to redeem their money market fund share would get nothing because there is nothing left in the fund, right? This creates a coordination problem among money market fund investors, which sometimes can cause money market fund investors to withdraw their money out of fear of being left with nothing. Stablecoins working in a similar way have a similar problem, right? And however, money market funds and stablecoins can both be runnable in the sense that I just explained, but it doesn't necessarily mean that they both, the runs work in the same way and are originated in the same way. So in this paper, we try to understand how far we can push this metaphor, how similar are the runs, are there flights of safety in stable coins as well, etc. So here is a bit of background on money market funds. Money market funds are very large. They have about, in the US, $5 trillion in assets. As I said before, there are prime and government funds. Prime funds invest in commercial paper, certificates of deposits, US Treasury and agency debt, as well as repurchase agreement as lenders, right? They are riskier. In 2008, there was a proper run on one such fund. In 2020, there were very large outflows from several funds at the same time as roughly the beginning of the COVID pandemic. Government funds invest only in US Treasury and agency debt and in repo loans as lenders, but only repo loans backed by Treasury and agency instruments. So they're much safer and they consistently experience inflows in stress periods. However, I want to highlight that, for instance, in the past decade, we have observed large outflows from some government funds into other government funds. For instance, between European funds, at some points in the recent history, some countries in Europe were perceived as weaker by investors, and government money market funds exposed to such countries had outflows in favor of money market funds holding the debt of countries that were perceived as stronger. There is also another important differentiation in the space of money market funds, and that is the one between retail and institutional funds. Retail funds are devoted to physical persons, and so that these are the funds where you and I would invest typically, and then there are institutional funds where only institutional investors should participate, or where institutional investors are allowed to participate. And the existence of institutional investors in the pool of investors of a fund somewhat worsens the sort of prisoner dilemma that I explained before, the mechanism that drives the runs, because institutional investors are assumed to pay more attention, to be more sophisticated, and so if I were in a pool with other institutional investors, I would say they're going to run really fast because they're paying attention every day to the value of the fund's assets, and so this exacerbates the investor coordination problem. So stablecoins are crypto token that live on a blockchain, and their goal is to maintain a $1 value, or there are also stablecoins pegged to other currencies, but I will say $1 as a stand-in for any other currency as well. There are three main technologies behind stablecoins. One is fiat-backed, fiat, not like the Italian car manufacturer, although there is a tenuous link between the two words. It's backed by fiat currency, so currency that is established by the act of a government. And so these are the ones that really look like money market funds. They take money, they invest it in traditional finance assets, and then they return your money on request. There are US-based ones and offshore ones. That is another distinction. Now, it is an important distinction because US-based funds tend to be backed by short-term, liquid, safe assets, lots of treasury, including US MMF shares, certificates of deposits with US banks. Offshore, and the poster child for US-based fiat-backed stable coins is USDC. There is then offshore funds such as Tether. These are also one-to-one backed by US dollar-denominated assets. However, they take more risk with their collateral. And they are also typically not US regulated, and they hold, they're also more opaque. Tether is essentially not audited by anyone that you would recognize, and it holds a very large variety of assets in its reserve fund, whose valuation is at best opaque. Then there are crypto-backed stable coins, such as DAI. These are issued by some sort of blockchain robot machine where you put some crypto stuff in a box and you get some stable coin in exchange. I will explain in a moment a bit more about how this works. And then there are algorithmic stable coins that are unbacked. When there is simply another much simpler blockchain robot that when the price of the stable coin goes below $1, it tries to reduce the supply, and vice versa. And again, I will talk about the mechanism a bit more in a moment. So fiat-backed stablecoins really resemble MMFs. It's interesting to, as I discussed in a second ago, to notice that there are offshore and US-based stablecoins, and that they differ not only by their legal regimes, but also by the type of portfolio that they choose to hold. And that resembles a lot the distinction between government money market funds and prime money market funds. It is interesting because I guess, generally speaking, there are large economies of scale in asset management, and these economies of scale drive some sort of attempt at instead of doing exactly the same as some incumbent is doing, I will try to do something else. So one tries to differentiate and offer a different product, right? And so I guess this safe versus a little less safe, but investing a little more aggressively is a first order differentiation mechanism that a stable coin issuer could have gone to, and they did. One really important difference, however, between stable coins and money market funds is that stable coins typically do not pay the yield on the assets to the stable coin investors. That is great because you get to keep up. It's like being a money market fund that charges fees equal to 100% of the returns. Normal money market funds can't do that, or nobody would put their money in it. But there is so much demand, or there has been at least so much demand for money that has a fixed dollar price and also is on the blockchain, that investors have been willing to accept no yield for the convenience value of having this thing. Again, the largest ones are Tether, an offshore stablecoin. That is $84 billion of assets under management, and USD coin, which is US issued. It's US audited, I believe, by Deloitte, if I remember correctly, and has about $25 billion in AUM. So some people seem to like opacity because both coins provide otherwise essentially the same service. Then there are crypto-backed stablecoins that are issued automatically when investors deposit collateral in a vault. This is a scheme of DAI, how DAI works. Why is it so complex? This is each box there is a smart contract on the Ethereum blockchain. There are mechanisms to stabilize the peg, mechanisms to handle the vault, mechanisms to do margin calls when the collateral value goes down. And typically, these things are collateralized by volatile assets, so you have to put down, for instance, $1.7 worth of Ethereum to take out one DAI, $1 worth of DAI. And then there are algorithmic stablecoins like the famous Terra that blew up in 2022. There is a sort of arbitrage mechanism such that if the price is less than 1, you somehow decrease the supply. In the case of Terra, you would burn 1 Terra token, reducing the supply, and you would get $1 worth of freshly minted Luna, which was another token whose price was floating, right? On my desk over there, I have 2 empty coffee cups. And to understand the fragility of this type of mechanism, so probably all of you value my 2 empty coffee cups at 0. If I take one and I throw it away, you will still value the remaining coffee cup at 0, right? So there is only so much that this mechanism can do, and Terra understood this last year when its market value went from 19 billion, with 19 billion outstanding token worth $1 each, to 0. But interestingly enough, the actual number of tokens in circulation is still close to 10 billion, as Terra technically still exists, but they're not worth $1 each, and so the market capitalization is a lot less than 10 billion now. So these are time series charts of color-coded portfolios of money market funds and stable coins. You can see that there is a lot of overlap between the two. If I were a stable coin, a fiat-backed stable coin holding a portfolio of US-denominated assets, it is so good to get all the yield for free that I would want to be super safe. And so even the offshore ones do hold substantial amounts of treasuries, such as you can see, Tether. Half of its holdings, self-reported, are treasuries. Okay, so now our empirical analysis. I still have, I believe, 10 minutes. Is that correct? Good. So we have, first of all, there are runs and there are runs with flights to safety. Do we observe flights to safety when we observe a stable coin run? Right? If so, which types of stable coins benefit from this flight to safety? Second, flights to safety often happens within a mutual fund family. Can we see something similar for stable coins? What is the equivalent of a mutual fund family for a stable coin? You can think of it as the platform. The platform is the blockchain. So there could be flows between one stable coin and the other on the same blockchain. We're going to go and see whether that happens. And finally, as I will explain in a moment, money market funds can break the buck. That is, they have to abandon their $1 peg. Is there a similar effect, like a discrete type of threshold for the value of stable coins? So we have obtained our data from CoinGecko for the most part. We collected price and number of tokens outstanding for the 12 largest stable coins, which is more than 99% of the market capitalization. This is really a winner-take-all game. There are really 4 very large ones and many middling ones, and then many very tiny ones. So we collected also the Bitcoin price, and we were lucky enough to find information on blockchain-specific flows, because stablecoins can appear on multiple blockchains at the same time. You can buy Tether on the Ethereum blockchain and on the Tron blockchain. I'm going to skip this slide, but this is a summary of what we have collected. And so we actually did two focus studies on two large events where we know that there was some really big stress event in a qualitative sense based on the news and what we know. One was the Terra Luna system collapse, and the other was the 2023 collapse of Silicon Valley Bank, which was kind of harmful for the USD coin. USD coin is the safe one, as I said. Unfortunately, they had an account with Silicon Valley Bank, probably the largest account, if I remember correctly. And so this was well known, and so immediately investors started to withdraw money from USDC, being afraid that the reserve fund of USDC had lost money in the Silicon Valley Bank collapse. And in both cases, you can see that there is a run, so to speak. So there is a large outflows from the type of coin that is considered risky. In the case of the Terra Luna collapse, there was stress that originated in the crypto world, and so the more crypto-like stable coins lost assets, and at least some of this money went into US-based coins, the ones that were perceived as safe. In 2023, however, the stress originated in the traditional finance world, and you can see that US-based, more traditional finance-tied stablecoins lost assets at the same time as offshore stablecoins gained assets. So we can see at least two clear instances of flight to safety. We also run some regressions. The regressions here simply formalize the evidence you just saw in the charts. It's statistically significant. There was a before and after effect. We ran some very simple difference specification. We can also break it down by the type of offshore stablecoin. So you can see that algorithmic stablecoins are the ones that are not backed, and they lost the most funds during crypto stress, vice versa. You have different inflows into offshore stablecoins during the SVB collapse episode. And the most money goes into crypto-collateralized stablecoins, which are at that point perhaps the safest, or perceived as the safest. We then try to generalize our analysis for a broader definition of stress. Instead of two discrete episodes, we had a continuous sort of measure of stress. And for a larger stablecoin sample, so all 12 over a 2-year period, we define stress as drops in the Bitcoin value. So the red lines, the vertical red lines indicate stress episodes. Those are the top, I believe the top 10% or the top 5%, I forget, of Bitcoin drops. And we assume that Bitcoin prices reflect general sentiment in the crypto world. So days with a bad Bitcoin return are days of bad sentiment in the crypto world. We do see that shocks to Bitcoin predict aggregate stablecoin flows. So there is some relevance in our instrument. And so we did the impulse response estimation, right? And you can see that on the typical, in the days following a Bitcoin stress shock, US-based fiat-backed stablecoins actually gain assets, whereas offshore crypto-backed and algorithmic stablecoins lose assets. And the scale on this chart is not the same. In fact, it is, see, 4, 8, and 16. So by far the largest outflows are for algorithmic stablecoins. And so this is not entirely driven by one episode. This is equal weighted across time. So this is definitely not just the Terra episode when one large algorithmic stablecoins lost a lot of money. We finally look at how investors run. Do these runs resemble money market fund runs? Again, as I anticipated, we study within blockchain correlation, right? See, on the days when money flows out of offshore stablecoins, do we also see that money flows into US-based stablecoins. And you don't need to see the details of these 12 charts, but you can see these are money market funds in 2020, and there is government versus prime flows, and so a positive slope shows that there is a flight to safety, okay? This is the same for aggregate stablecoins. We see, generally speaking, on the days when you have negative flows from offshore coins, you have positive inflows into US-based coins. We then look at individual blockchains. So these are all the stable coins that live on the Ethereum blockchain. And again, you can see on the days when offshore coins on the Ethereum blockchain have outflows, there are positive flows into US-based coins on the Ethereum blockchain, and so forth. However, the pattern holds only for the top 3 largest, for the blockchain containing the largest stable coins, so Ethereum, Tron, and Binance. If you go to the smaller blockchains, this pattern is reversed. That suggests that, so on a day when there are outflows from offshore coins, there are also outflows from US-based coins. It's as if money is simply leaving the platform, the blockchain. So there are bigger blockchains that inspire more confidence, and there you can see a flight to safety within the blockchain, and then there is a flight away from the blockchain itself in the smaller, less solid ones. Finally, we identify the pegging threshold. Money market funds are supposed to maintain a stable value of $1 per share. If there is a net asset value that is a shadow number behind this fixed peg. If the number becomes less than 99.5 cents, the money market fund is said to have broken the buck, and the shadow net asset value becomes the actual price of the money market shares. And so this has happened once, and there was a run, and it was very bad, right? So our results show a threshold at 0.99 for stablecoins. Well, stablecoins are not forced to, they don't have a shadow number, but I guess there is a psychological threshold at 99 cents. A stablecoin that is priced between $1 and 99 cents has outflows, because that is, generally speaking, a bad thing, but it's only 0.34% of assets per day. As the price goes below 0.99 and up to hold on. I think, did I? Ah, yes. Okay. This should have been 991. That's a typo. I apologize. So when the price falls below 0.991 and touches the psychological threshold of exactly 99 cents, if you round to the second digit is 99, then the stablecoin experiences a daily outflow of 3.43% of assets, so 10 times as large. If you go down 1 more cent, it becomes small again, or at least no more than it was. So the large amount of negative flows happen around the 99 cent threshold. I don't know if it's because there are algorithms programmed to sell, or because news. There are many mechanisms that could drive this, but it exists. Okay, concluding, stablecoins are increasingly important. They resemble MMFs. This has been said before, but in this paper we go deeper. We take this metaphor very seriously, and we show that actually, in addition to being runnable like money market funds, runs that actually did happen did resemble some qualitative facts about money market funds. We also show that there are flights to safety within the same blockchain, but only in blockchains that inspire enough trust that money doesn't want to leave the platform altogether. And we finally document a break-the-buck threshold at $0.99 per token. Thank you very much, and I will leave it to the discussant now.
Well, thank you so much. That was a great presentation. before anything, before I forget, this does not represent the views of the fund management of its board. It does represent the views of my colleague Marcello Micoli, who presented another paper. We discussed this together, so I want to acknowledge him here and make him accomplice in the act. Now, before, I'll try to keep it short, so there's time for questions to the author, to the presenter. I just wanted to take a step back, and why we are discussing this now. Remember 2019, we started paying more attention to stablecoins when Libra and Facebook kind of tried to move forward, and we all worried that it became something systemic. Personally, again, my own view, it hasn't become systemic yet. We may worry now whether PayPal's new project with Paxos could actually end up being the killer app that would make stablecoins leave the crypto ecosystem and become part of economic life more, for a broader audience. We don't know yet, right? So that is a long introduction to say this is a very relevant discussion, right? That continues to be relevant and will continue to be relevant till we figure out how to deal with stablecoins. And why is that? Because stablecoins are new and they share characteristics with different types of money-like instruments, one being MMFs, but there are others too, right? For me personally, they have some properties common to exchange rate pegs, right? So that's another analogy. So maybe a way to put that is that, you know, the parable of the blind man and the elephant, right? That one touches the leg and says, well, this is something, this is a column. One touches the tusk, one touches the trunk and says, oh, this is a hose. So I think we've been doing that a lot. I don't have the answer on, this is the elephant, right? We don't know it yet. We don't know how the elephant will look like. This is describing, this paper, I think it's describing one dimension of that problem, which is how do stablecoins compare to MMFs, one type of money-like instrument, right? So some similarities between stablecoins and MMFs. Both are money-like store of value. As presenter said, this is a promise of redemption at par, and that obviously creates once there's maturity transformation there and probably liquid transformation as well, it creates run risk. There's no public backstops for either of stablecoins and MMFs. So typically, there are exceptions, of course, in stablecoins like the algorithms and basically the algorithm stablecoins, but by a large share, both. The most important stablecoins use the balance sheet to sustain the peg, preserve assets, same as MMFs. And of course, there's some heterogeneity within stablecoins and within MMFs in terms of what assets they use as reserves, right? Government and prime MMFs, or the different types of balance sheets that the paper shows and we just saw. So what the paper does, I think it documents sort of the runnability and the stress triggered by the fall in Bitcoin prices, documents the contagion in runs and how that kind of plays out, and how different how basically when there are these idiosyncratic shocks to Terra or USDC, where do the funds go to in the crypto ecosystem and in stablecoins? And the price threshold for stability, the 0.99. So before I go to the differences, I think, and some other dimensions, I think here something that I would stress a bit more, or I would try to disentangle a bit more in the paper, maybe for another revision. I think these are different types of shocks, and so commingling them, it's not this. So a Bitcoin price is basically an aggregate shock to the crypto ecosystem, right? It plays out in different ways, as we saw, right? There's a differential inflows and outflows to to US, basically to USDC or to, and running away from the riskier stablecoins. But it's different from an idiosyncratic run against Terra or USDC, right? So I think that's, there's a bit of tension there, and I'd like to see maybe a bit of how that compares to MMFs, again, in terms of aggregate shocks or idiosyncratic shocks. Minor point on the regressions, there's very little variability. There are very few observations in the cross-section and very few observations that actually matter, because there are basically 2 or 3 stable coins that represent, I think, 90% of the market cap. So maybe there's something to be more explicit about in the paper. Of course, there's a lot of time series, right? But running an event study at the end is just looking at what happens in the cross-section before and after. So I'd like to see a bit more in terms of robustness and basically looking at what observations are actually influential. Same spirit as what we may have seen in the chart with the observations and those lines. But again, sort of trying to take a very humble step back on what is the elephant, right? So stablecoins are not the same as MMFs, right? They do they do have a promise to redemption at par. They use the reserve assets mostly to sustain that, but there are differences. There are very important differences. MMFs are remunerated, stablecoins are not. Stablecoins are more like money in a way, that closer to fiat money that is not remunerated to the public from that dimension. So then, for instance, stablecoins are going to be much more exposed to the monetary policy cycle, right? We've seen it. I mean, it's true that they haven't collapsed because the crypto system is surprisingly resilient, but basically it is, as interest rate went up, inflows to crypto and to stablecoins became negative. And as such, stablecoins are part of an ecosystem, right? They live for crypto. They may be used in some very specific cases for cross-border transactions, and some more than the others. USDT, mostly, Tether. But for the most part, they're part of the crypto ecosystem, and they're used as settlement asset for buying and selling crypto, right? It's not just parking and getting a relatively safe interest rate out of them, because you don't make money out of stablecoin. You need to go somewhere else. You need to go to an AMM and deposit that, for instance. But stablecoin itself is a settlement asset, and it's part of the payment infrastructure, right? Part of the payment system, if you want. They are mostly outside the regulatory perimeter. Of course, there's variability, right? Some have like some sort of license in different states in the US, for instance. But still, this is something that is still very much in flux, and it's very different from MMFs from that respect, which we had basically was a regulatory reform. There's clarity on what MMFs can do and cannot do, and that's why they are part of the mainstream financial system, and stablecoins are not. As such, related to those 2 points, there are obviously operational risks. There's arbitrage in where I localize the stablecoin issuance, right? Do I put it on an offshore center and I do a more sketchy operation, or I try to become more mainstream and hope to get some US regulatory approval at some point, which is maybe PayPal's game, or Libra at the time in Switzerland. But maybe what I like to go back to the issue of aggregate shocks to the ecosystem and the analogy to exchange rate regimes. In a way, you could think of the crypto ecosystem as a kind of small open economy subject to aggregate shocks, right, for the economy, right, which are shocks to terms of trade, which are the Bitcoin prices. And that's very different to the types of shocks that MMFs or that the regulation for MMFs deals with, right? Regulation for MMFs deals with basically how to ensure that reserve assets are sound, that they're relatively well backed. So what I mean to say is that the types of shocks that the paper does in terms of the Bitcoin price collapses, for me, it resembles more like shocks to terms of trade to a small open economy, right? And the pressures that an exchange rate regime may suffer when those shocks happen, right? This happens to be a Ponzi-like economy, right? It's not an actual economy. But still, right? Again, I'm looking at one of the legs of the elephant, not the whole thing. So maybe to wrap up, what I try to I think my message is like, at the end of the day, we're trying to find a way to understand what stablecoins are and what they may become later on, right? And that's very important for policy, right? How we want to shape regulation, what do we want to allow the mainstream financial system to deal with this? So then there are going to be commonalities, of course, with MMFs on the reserve, basically on the backing side of things, but there are going to be a lot of differences in many risks that stablecoins are exposed to and will be exposed to, and different ways in which they can trigger contagion to other parts of the system. So that's a kind of a general message. This is not for the paper itself, which I think it does a nice job in comparing one dimension with MMFs, but maybe it's something to maybe flag a bit more clearly. And then on the more detailed side, I think it'd be nice to have a bit more, I mean, given this is an empirical paper, to have more robustness analysis in terms of how the episodes identification, the stress episodes identification is done, right? How it would look like when you only look at, I don't know, cumulative falls in prices of Bitcoin, or larger shocks, or you have fewer shocks. I mean, there are many different ways to do that. Again, literature of capital flows, basically spent decades doing that. And again, as a detail, maybe I think, and maybe I'm wrong, I think there are no interactive terms in the regressions, and the number of observations in the cross-sections are quite small, so maybe maybe it'd be important to be a bit more explicit about how the results would look like without, in different specifications and with. Thank you so much.
So, thank you, Federico, Mattia. I think in the interest of time, I suggest we proceed to the next paper, so we can, keep on time for the keynote speech later. So, Sharon.
Okay. Well, thank you so much to the conference organizers for selecting our paper. I'm Sharon Ross, and I'm very excited to present my paper, which is called Leverage and Stablecoin Pegs. This paper is joint work with Gary Gorin, Beth Klee, Chase Ross, and Alex Vardalakis. Beth and Alex are in the audience today, and I'm sure they'd be very happy to discuss the paper with you also. So this paper is also about stablecoins, which are, as the previous presenters mentioned, digital assets that promise to maintain a constant price of $1 and to be redeemable at par on demand. So there are different types of stablecoins. There are those that are collateralized by assets, commonly traditional financial assets. And some of the largest stablecoins like Tether and USDC and DAI are collateralized. There are also algorithmic or uncollateralized stablecoins like Terra. And the focus of our paper today are going to be primarily on collateralized stablecoins. So stablecoins, because they're backed by underlying traditional assets, you could think of it very simply as a combination of, let's say, treasuries and commercial paper. Well, some of these underlying assets are possibly illiquid, and as a result, stablecoins are subject to non-trivial run risk. However, the issuer doesn't directly compensate holders of stablecoins for this run risk. The issuers generally do not pay any interest. So holders of the stablecoin are holding on to these stablecoins that have run risk, but they're not being compensated by the issuer. So the question in our paper is, how can stablecoins maintain their peg despite the fact that there is run risk and the issuer doesn't pay any interest? So the answer is going to be that in secondary markets, stablecoin holders can earn high interest rates by lending out the stablecoin. So stablecoins have, as the previous presenter noted, grown quite substantially over the last couple of years. And they've been able to maintain their peg for the large part over this period. So the contribution of our paper is to show that runnable debt can maintain a peg as long as it's useful for speculation. So demand from stablecoins comes from their use to take leveraged positions. So people demand stablecoins to use as underlying collateral to get levered exposure in other more volatile digital assets like Bitcoin. And stablecoin holders are going to be indirectly compensated for the stablecoin's run risk because they can lend the coin out to these levered traders who demand the stablecoins. So when they lend them out, they're going to earn high lending rates, and that's going to help keep the stablecoin pegged to $1. So specifically, we have in mind that we capture the idea that there are two opposing forces that keep a stablecoin pegged to $1. The first is that the stablecoin has run risk because their underlying reserves include illiquid assets. And the second is that levered speculators are willing to pay high borrowing rates. So these borrowing rates, or the lending rates that the stablecoin holder earns, are going to compensate for the run risk that stablecoins have because of their illiquid assets that back them. So stablecoins, as we've been talking about during this session, has financial stability implications. So the stablecoins are a very important linkage between the traditional financial markets and digital asset markets. And this is because the reserves of the largest stablecoins are held in traditional financial assets. So say there's a shock to crypto markets. Well, the stablecoin issuer can adjust their reserves, and by doing so can lead to volatility in money markets, which we capture in the model and we'll show more details about soon. So these reallocation in the traditional financial holdings can be very disruptive for the real economy. There's evidence that Tether at one point was the the third largest holder of U.S. commercial paper. And there's a paper by Sang Kim that shows that increase in the issuance of major stablecoins is directly going to lead to an increase in commercial paper issuance in the following day. So stablecoins provide this important linkage between traditional markets and crypto markets, and shocks to one can filter to the other through stablecoins and in both directions. So I'm going to talk briefly about the model. We have a lot more details in the paper. The model is combines a bank-run model akin to Goldstein and Pausner with a model of leveraged collateralized trading, similar to Grom and Vallanos or Brunemeyer Pedersen. In the model, there are three different agents. There's a stablecoin issuer, stablecoin investor, and a cryptocurrency trader. So the stablecoin investor, or the agent that's going to hold the stablecoin, they're going to give money to the stablecoin issuer. And the stablecoin issuer is going to issue them a stablecoin. This is the standard minting and burning of stablecoin tokens. The stablecoin issuer is going to take the money liquid assets. And specifically, in traditional financial assets. Again, you can think of this in your mind as a combination of treasuries and commercial paper, where commercial paper can be more illiquid. The stablecoin issuer earns the expected payoff from these traditional assets, but it doesn't pass on any of this return to the stablecoin investor. It doesn't give them any interest for holding the stablecoin. So the stablecoin investor now has run risk, and it's not being compensated on the primary market by the stablecoin issuer. So what can it do? It can lend out its stablecoin to cryptocurrency traders who want to use the stablecoin to get levered exposure into other digital assets like Bitcoin. What the stablecoin investor is going to get at the end of this margin loan is the stablecoin combined with some interest. So the cryptocurrency trader is now going to use the stablecoin that it's borrowed and perhaps combined with its own funds to invest in the speculative cryptocurrency like Bitcoin. And of course, they earn the payoff from doing so. So you can see very clearly here how stablecoins provide this important linkage between traditional financial system and the digital asset system. So say there's a shock to commercial paper markets. That could quite simply increase the run risk of the stablecoin. So that's how a shock in traditional markets can translate to concerns in digital assets. On the flip side, say there's now a lot of crypto volatility or lower demand for the stablecoin. Well, the way that the issuer is going to adjust to maintain its peg are going to involve changing their holdings of the underlying reserves, which are, again, traditional assets. So by doing so, if it either moves from a greater holding of commercial paper to treasuries, or if it sells off some of their underlying reserves to meet redemptions, these are both going to lead to potential problems in the traditional financial system. So this is how, of course, on the speculative, how digital asset shocks can translate to concerns for the traditional markets. So again, the linkage really goes in both directions. The model is a 3-period model. At time t equals 0, investors are putting money in the stablecoin and getting their tokens. And the issuer is making that investment in traditional financial assets that are liquid and illiquid. At time t equals 1, investors get a private signal about the reserves, the illiquid reserves, and they make a decision whether or not to redeem. And if there are enough investors that redeem, the stablecoin will face a run. At time t equals 2, if there is no run, then investors lend out their tokens to traders who use it to take a levered position in crypto markets. So that's a broad sketch of the model. There are some important components of the model that I'll mention now. So the first is, of course, the stablecoin lending rate. Excuse me. Which makes traders break even between a levered payoff and an outside option. The lending rate is increasing in speculative demand, and we'll show this empirically in a few slides. In the model, global game techniques pin down the unique probability of a run. And the stablecoin issuer is exposed to run risk because the liquidation value of the stablecoin reserves might not be enough to cover if everyone chooses to redeem. One of the results here is that the run risk is going to be decreasing in the lending rate and also decreasing in the share of liquid reserves. A simple way to think of this is let's compare a stablecoin that has 95% treasuries and backing and 5% commercial paper backing. Well, if a shock happens and needs to liquidate quickly, you might expect that it would have an easier time meeting those redemptions, and the run risk would be lower. Compared to, let's say, a stablecoin that has the opposite, 95% commercial paper and 5% treasuries. The main proposition in the paper is about how can the stablecoin issuer maintain their peg. and when it faces shocks that might push the stablecoin price below its peg, for example. So there are a few different possibilities that might push the stablecoin to be below its price of $1. The first, for example, would be lower demand for the speculative cryptocurrency, or if there's higher crypto risk or greater volatility in digital asset markets generally. So in the model, there are two different options that the stablecoin issuer has to bring its price back up to $1. The first we call the liquid asset portfolio share channel. So the issuer can increase the liquid asset holdings while keeping the supply of circulating stablecoins constant. So this would be shifting from the more illiquid reserve to the more liquid reserve. So let's say simply shifting from commercial paper toward treasuries in its underlying backing. The second is the redemption channel, where you would keep the share of liquid and illiquid asset backing constant, but now allow for the fact that there's lower demand for the stablecoin to manifest in more redemptions or a lower supply of circulating stablecoins. So the issuer has these two different channels that it can take to maintain its peg. And in the model, we have details about whether about the redemption channel in the two cases of whether or not this liquid asset holding, the first channel, we have details about whether or not L is observable or not. Because as many of you might know, some of the stable coins only release their underlying reserves details at perhaps like quarterly basis at best. So rather than daily. So now I'll talk about some of their main empirical results that we have in the paper. The first is that we want to confirm the models prior that speculative demand drives the stablecoin's lending rates. Then we'll provide empirical evidence of the two channels for peg stability, the share of of liquid assets and the redemptions channel. And the model in the paper, we have some more details about event study of when in May 2022 when Terra faced a run, and we show that the dynamics that we capture in the model is consistent with what empirically happens in May of last year. So to show you some summary statistics, I have here at the top the stablecoin price for Tether and DAI. And you can see that in general, it is pretty successful at maintaining its peg. On the bottom panel is the margin lending rate. So this is the lending rate that holders earn by lending out their stable coins. And you can see that that's around 7 or 8%, so quite substantive. So what we want to show we show in the model and we want to confirm now is that levered trading demand drives the interest rate. So we're going to measure levered trading demand using perpetual futures funding rates. So perpetual futures are liquid derivatives that allow for leverage, very high leverage. And this is one of the largest and most liquid derivative markets in crypto markets. There's more than 40 billion in daily volume in May of 2022, and these futures are stablecoin settled. So you can think of these perpetual futures as very similar to a standard future, but now there's no date at which of expiration that you would expect the spot and the future price to converge. Instead, for these perpetual futures, there are funding payments that keep the spot and future price close together. So if the future trades at a premium to the spot, investors that are long the future are going to pay a positive funding rate to investors that are short the future. And this is what empirically the perpetual futures funding rate looks like. It has about an average of 20% and a standard deviation of about 30%. So it moves around quite a bit. So again, we use this perpetual futures measure to measure speculative demand. So on the x-axis here, we've plotted the perpetual futures funding rate, which I just described. And on the y-axis, we plot the Tether's margin lending rate, so the stablecoin lending rate. And you can see in this scatter that as speculative demand is higher, the stablecoin lending rate is higher. Of course, this is a correlation, even if we run a regression, and it's statistically significant, but it is a correlation. So we want to get to a little bit more identification. So the chart shows that speculative demand is positively correlated with the stablecoin lending rate. But there might be something else in markets, specifically in crypto markets, that might be affecting both. You might think even outside of crypto markets, general business variation might be important for both. So we're going to instrument for speculative demand using something that's outside of digital assets. We're going to use Major League Baseball viewership. So MLB and FTX had a sponsorship deal, and it put the FTX logo on all umpire uniforms. This wasn't something that was commonly done for MLB, and umpires wore this patch for all regular season, postseason, and spring training games. And you can see in the graphic, in the photo here, that the logo was quite large and visible. So we're going to collect television viewership data on nationally televised MLB games. Our data starts in July 2021, when the patch was still first added to the uniform. And our data for this is going to run through November 5th, 2022. So that's the end of the World Series last year, and also conveniently the day before FTX collapses. Yeah, worked out well. So the instrument that we're going to use is the daily average household rating, which measures the percent of households watching the game. We think that this might satisfy the relevance condition because of a large literature about how advertising is effective. And empirically, we show that our instrument is statistically strong. For the exclusion restriction, we think the baseball schedule is set well in advance of the season, and it seems improbable that crypto events affect the timing or viewership of baseball games. So this is the second stage regression. So in the first stage, we've used the household rating to estimate the futures funding rate. And now this is the regression of the stablecoin lending rate on the estimated futures funding rate, our measure of speculative demand. In the first row, you can see the coefficient is positive and significant, which suggests that if there's a higher speculative demand, then the stablecoin lending rate will be larger. So to put the coefficients in perspective, if you had a 1 standard deviation increase in speculative demand, that would translate to the stablecoin lending rate increasing by about 50% or so. So now I'll discuss our results related to pegs, how the issuer is able to maintain their peg. So as I mentioned before, there are a couple of things that might push the stablecoin price below its peg of $1, like a decrease in speculative demand. So in order to stabilize the peg, the issuer has two options. It can change its share of liquid and illiquid underlying reserves, or it can allow for more redemptions. And the issuer has these two options to stabilize the peg. So let's focus here on the left-hand side graph to start. What we're going to plot is we're going to look at Tether's quarterly disclosures. As I mentioned, some of the stablecoins have some details about their underlying reserves, but it's often quarterly at best. So this is 7 data points here. So what we've done in the left-hand side graph is we've plotted the liquid share of the portfolio on the x-axis, and on the y-axis we've plotted the perpetual futures funding rate, or measure of speculative demand. you can see that there's a clear negative relationship. And what this suggests is that as speculative demand decreases, the liquid asset share increases. And say you don't like our measure of speculative demand, on the right-hand panel, what we've shown on the y-axis, we've changed it to the margin lending rate, so which reflects speculative demand. So this is our evidence for the liquid asset channel, that as speculative demand decreases, the liquid asset share will increases to maintain the peg. The other channel that the issuer has is through the redemptions channel. As I've noted, the liquid asset share is not continuously observed, and it might be very difficult to sell off a large portfolio of commercial paper and buy treasuries instantaneously. So the other option is through the redemptions channel. So we calculate the net issuance as the change in the face value of the stablecoin, and we call net redemptions the negative of net issuance. So we have some summary statistics on the bottom here. You can see that about maybe 30% of the time there are redemptions for the largest stable coins. And if you look in the bottom right corner, you can see that when Terra collapsed and it lost 27% of its face value in a single day. So here we're regressing the change in the log of the face value of the stable coin on speculative demand, that variable y, and otherwise known as the funding premium. So you can see that there's a and across the first row, that there is the positive and significant coefficient, which what that means is that as speculative demand decreases, you have a decrease in net issuance or an increase in redemptions. So as speculative demand decreases, redemptions increase, consistent with our redemptions channel. Our model predicts that when you decrease the supply of circulating stablecoins, well, now your stablecoin lending rate increases. And we've regressed the change in the stablecoin lending rate on the change in the log of the face value of the stablecoin. And this negative coefficient shows that as token supply decreases, your stablecoin lending rate increases. With that, I'm going to conclude. So this paper is about stablecoins, which aim to be private money that maintains a peg of $1. So stablecoins are able to do that even though it's not no questions asked, in the words of Holmstrom. It's not information insensitive. But agents that hold these stablecoins have to be compensated for the risks. They're not compensated by the stablecoin issuer on the primary market, but they are compensated on the secondary market when they lend out the stablecoin. So stablecoins are used for speculation, and lending rates are really compensating for this run risk. So in this paper, we reconcile two important facts. The first is that stablecoins are not useful as money, despite their success at maintaining their peg. And second, that stablecoin lending rates are often very high and are correlated with measures of speculative demand. And lastly, very importantly, stablecoins are an important link between crypto speculation and the real economy. Thank you so much.
Morning. Thank you for the invitation and opportunity to speak. But you might be wondering, why is Scott Shue standing up here? And if you did, you'd be one of three people at least here today that are thinking that. Me, you, and the conference participant I ran into this morning who said to me, I see that you're talking about stablecoins. And sensing the skepticism in his tone of voice, he probably noticed that I was wondering why he would bring this up. And he quickly said, well, you've done lots of great things. It's just I'm not seeing you as a stablecoin guy. Well, I tried this argument on the conference organizers and did my best Bob Euchre imitation. And I said, you know, I would love to help you out, but this is just a bit outside my area of expertise. I'm a macro guy who's gone back to being a macro guy who dabbled in consumer payments for 20 years. And just to show you how bad I am about crypto. So in about early 2010, we were looking at Bitcoin and wondering, should we be tracking this as part of consumer payments? Is this money? Is this a payment? Whatever. Just starting to think about it. Okay. Well, back then, I actually was thinking about investing $1,000 in Bitcoin just for kicks, because I had a feeling this is one of those things that could really take off. And I just calculated this morning for the first time. I've been avoiding this for 20 years, or 14 years, whatever it's been. $34.6 billion is what I would have earned if I had invested $1,000 in Bitcoin. That is quite something, huh? Anyway, just further proof that, that I'm not suited for this discussion, but I'm going to do my best. And I don't have slides because I don't want to give the illusion that I actually know what I'm talking about. Any paper with economics and baseball in it is great, so I love that because baseball is my favorite sport. But here's my simple macro consumer perspective on summarizing this paper. It seems like to me it's investors with too much money and perhaps too many Super Bowl rings lending to issuers who don't have to disclose anything at all, so those investors can then make even more money lending to crypto trader speculators who actually might be linked to the issuers unbeknownst to everyone involved. So my first thought is, why would any consumer be involved in something like this? And the answer is they probably aren't. If you go to my students' poster session tonight, you'll see that the fraction of people who actually own Bitcoin that are using it for what it was originally intended for, like payments, has dropped dramatically since 2014, probably because this speculative motive has taken over. So let me just say, though, that I think this paper is a great public service. It reminds me of the 1/3 of my Fed career that I spent trying to help figure out what happened with the tripartite repo market and what reforms we needed and the great work that the New York Fed and others did there. You know, but I look back at that and say, the fact that the California Teachers Pension Fund wanted to give a lot of cash to Bank of New York Mellon and thought that there might be some kind of a repo underlying that with some famous investment companies, and that turned out to be kind of fairly opaque. When I read this paper and what the authors have shown, and this literature showing, is that like that was kids' play compared to what's going on here. This is incredibly opaque and challenging. Now, so the model, I have a few comments about the model, and then I have some bigger picture things that hopefully will get our questions kicked off. As far as I can tell, the finance part of this model is terrific. It seems like it's working. It looks like the paper's an R&R, so congrats to the authors if that is the case. But here's a couple of things I think about in the model that maybe might be helpful to them for future research. So the issuers that they build into the model, besides the leverage option, I wonder a lot, how is a stablecoin different from shares in a DDA, MDA, or an MMF? They just seem like they're basically doing the same thing, but are there any differences beyond the fact that these things are being levered? Second, do these issuers actually realize that they are essentially acting like central bankers because they're manipulating the money supply, the coin supply? But are they thinking beyond their profits and in ways that take into account synergies and externalities? For investors, they use this terminology of a patient versus impatient investor. So an impatient investor is someone who, I think, gives up on the fact that they could make a lot of money. And I thought that maybe thinking more about that and not casting it that way might be helpful. So these financial assets is it full information investors that are pulling out when they realize that there's this run risk, or the other partial information investors who don't know what's going on? Are these sophisticated versus unsophisticated investors? Maybe some are just better at it than others. Maybe it's not the patience. Maybe there's something more to it. The thing that I was curious about is, are there other options for stablecoin collateral? Why only lending to crypto speculators? And more generally, at the very least, I'd like to know, in the context of a utility maximization problem, what is the portfolio allocation decision that's being made here to do this kind of investing? And from a GE perspective on private money, I wonder, why are there so many middle people involved? Why aren't we just linking directly to the traditional finance asset to the cryptocurrencies? Why do we have so many players along the way? And then third thing for the market, for the model, is I found that it was kind of missing a link to the real market that was real obvious, which is the lending rate for the crypto is tied to all other interest rates. And in particular, it's probably tied to IOR or Fed funds, and that's tied to money demand. Although I have a student that's working on a money demand model that shows that money demand is much more closely linked to long-term interest rates than short-term interest rates. But in any case, the lending rate that's in the model is not tied to other interest rates that are probably really important in the big picture for what money is, right? So I'm curious about that. And in particular, the period of time in which these crypto prices went way up and then came way back down coincides with the zero lower bound, and that can't be a coincidence. Anyway, that also leads me to ask the question, if I wanted to do something like this now with reserves, 4+%, why don't I just back a crypto with reserves working with a traditional bank? And that all leads me to wonder, what is the backdoor entry into macroeconomics more generally? Now, a couple of big pictures. So those are just model things that I would think about building in future research. Several big picture questions. So I'm curious, what do these stable coins tell us about money and banking more generally, particularly unregulated banking? Because I find that the link to regulated bank deposits is so similar to DDAs and MMFs, but the thing that really struck me is the liquidity share allocations of roughly 30 to 60% are not very different from what I first learned was the case for banks prior to the Great Depression. So banks were voluntarily reserving 60%. That's kind of ballpark to what this is. So are they just acting like banks in the 21st century? I'd like to know a little bit more about that connection and that thinking. Then specifically with regard to connection to the real economy, it's cool that they're showing that the events in traditional finance markets and crypto speculation can be linked in what they call this indirect interconnectedness. But I think that's where I really want to know a lot more about what's actually going on. Does crypto speculation affect things that macroeconomists really care about, like GDP and inflation? Or not? Seems to me that there's a lot of ups and downs that we're not even looking at in FOMC discussions about standard macro stuff. Now, I think there's a natural connection to the real economy through the payment system. And this is the part of the paper that I wish they had done more of. They have a short appendix discussion of the yield for convenience for payments. But I think it's the fact that Bitcoin is still the only really directly payment system related crypto is what makes it different, and how these things get actually used for payments is crucial, and I'd like to see more of that. So are stablecoins really money? I think not. I think it's not the store of value we think about for money, which is if I have something in my account today and I want to buy something tomorrow, I don't want that to fall in half. I want that to still be at par. But these kinds of assets, like the complexity and the speculations in them, are kind of more get-rich-quick schemes. And I'm trying to figure out, why are we trying to build an asset-backed crypto money? I used to think that was the solution for Bitcoin volatility. But then I started thinking, wait a minute, developed economies have been going exactly the opposite direction over the last 150 years, right? We used to have precious metal-backed currencies. Now we have nothing that's backed. And Bitcoin, for all its warts and everything, is still just a pure fiat currency. They just said, here it is. Here's the network. Use it if you like. It's not backed by anything. And this whole discussion has got me rethinking, is that really what we want to do? Because in the old days, we hated the fact that gold prices fell in half and caused the collapse of the money supply. So is this really what we want to do? And the other thing is, the original motivation, I think, still for Bitcoin was the promise of a fixed money supply. And in the US, up until the World War II, average inflation was 0% as best we can measure it. Since World War II, average inflation is positive. So that's a real loss on holding money. And if you promise not to move the money supply around, which these stable coins have to do all the time, then we're losing that potential benefit. Lastly, I just want to say I'm a little surprised that the authors didn't push harder on the fact that there's government regulation screaming out here. It's why in the world do the central banks and governments allow this? Because it's sure screaming out for at least, if not deposit regulation, transparency. And maybe financial stability, although, like I said, I still don't see the fluctuations in crypto transferring into GDP. But then maybe it's because it doesn't really matter to the real economy. We need to see that. Or maybe the players in these markets just don't care about that because they're able to handle this speculative volatility. But if that's the case, then is it really money? I don't think so. So anyway, I hope that gets us kicked off. Hopefully there's time for better questions and answers.
Excellent, thank you. I think we have some 5-7 minutes for questions before the keynote.
Well, thank you, Scott, so much for your comments. This is, I think, really getting to a lot of the things that we think about are stable coins money? Are they useful as money? Are they, they're clearly private money. I think I would argue that probably, in general, they don't carry, I have another paper that shows that they have a negative convenience yield. So they aim to be money, but I think they are bad money because they have a lot of frictions in being used. Relatedly, you talked about the usage of stable coins as payments. And as you mentioned, we discussed a little bit in the appendix if there's this alternative demand outside of speculative demand, but now for use of stable coins in a payment system. And we just, bottom line in the terms of the model, it shows that it's the mechanisms we have in mind are still consistent. In fact, some of the channels are a little bit strengthened, specifically the redemptions channel. But maybe more broadly, do stablecoins want to be money? Do stablecoin issuers want that? I think the answer is probably quite simply yes. If there's a stablecoin that could be both useful for speculation and form a means of payment, it would probably capture a lot of the market share. But so far, stablecoins have really had a lot of challenges in being used in payments. I think people have concerns about, for instance, the backing of Tether, one of the largest stablecoins, and concerns about the risk management of USDC with SVB. So I think that somewhat more recently, for instance, PayPal has issued a stable coin, and I think that they, in many ways, would maybe aim to be able to do both, be useful in speculation and separately useful as a means of payment. And I think that they are probably, opportunist. I mean, they have a reputation already, and they can rely on that perhaps to be a better form of private money. In another paper, some of the co-authors and I show that reputation is very important for the development of private money and in its ability to potentially earn a convenience yield. Relatedly to, I think, one of the questions was about kind of regulation, if it's regulated or not. I think one of the components of stablecoins is it's very similar in a lot of ways to money market funds, except in some ways it's really perhaps more concerning because they're like unregulated money market funds. So I completely agree on that point. That regulation's an important thing to consider. Some of the other comments have been related to, were about like central banks or somewhat relatedly, like how is this related to an issuer being kind of related to, similar to a central bank, or I know in the previous discussant they talked quite a bit about currency pegs. I think that there's, for a currency peg, for example, the central bank is making decisions about the relative demand of the currency based on its underlying reserves and ultimately its policy goals of setting short-term rates. In comparison, the issuer of stablecoins, that's not the case at all. They clearly don't set short-term rates, and they are profit maximizing. Empirically, we show, I believe it might be in an appendix, that the stablecoin lending rates are also not correlated to short rates like effective Fed funds. One of the other comments was about why are there so many players in the model, for example. It's just to separate it out. In reality, holders of stablecoins could also be cryptocurrency investors. So you could, it's, if you hold one stable coin, perhaps you borrow a different one to get levered exposure, or you might hold it and then, so it could be, I think it's separated out for the intuition's purposes. And then to compare briefly the patient and impatient investors, there's a question of whether the patient investors were just, those who don't want to make money. Well, these are ultimately the investors are going to be for the stable coin. So if they hold, the difference between redeeming or not is really whether or not they hope that they'll be able to get a dollar back. So I'm also happy to take any questions. Or I know the previous person also didn't have a chance to respond. So.
All right, I think we need to move to the next item on the agenda. Thank you very much, Sharon.
Thank you.
And others for the presentations and the discussion. It was a really great session.
Okay, good afternoon, and let me also extend a warm welcome to the Federal Reserve Board here. Happy to be hosting the economics of payments again for the second time. I think the first time was back in 2011 in slightly different, a less modern set of facilities, even though it was in the same building. So we're very happy to be able to host again, and looking forward to continuing to talk with many familiar faces around the tables, as well as a lot of new folks here. If you don't know who I am, my name is Dave Mills. I am in the payments division here in the Federal Reserve Board, and I work with Ellen and the team, who, again, I also would extend a lot of thanks for organizing this conference for us today and tomorrow. My role today is very limited in the sense that I am going to be here to introduce, I have the privilege of introduce our keynote speaker for the day, Sir John Cunliffe. So Sir John Cunliffe is the Deputy Governor for Financial Stability at the Bank of England, and he's been so since November 2013, and will be so for a few more days as his term will be up at the end of this month. He has specific responsibility within the bank for financial stability and for the supervision and oversight of financial market infrastructures and payment systems. He is also a member of the G20's Financial Stability Board Steering Committee, and perhaps most importantly for this conference, is also the chair of the Committee on Payments and Market Infrastructures at the Bank for International Settlements, which is a place where I interact with John quite regularly on. And just an interesting thing to sort of point out about that, I think John has seen a lot of variety of topics related to payments and financial market infrastructures in his term as the chair of the CPMI. And it has included a lot of the topics that we're touching on today. And so one of the sort of interesting elements that he's had responsibility for in his role at the CPMI has been to help advance a lot of the international thinking around improving cross-border payments, as well as dealing with a lot of issues related to digital assets, such as stablecoins and central bank digital currency topics, both of which are being discussed at this conference. So without further ado, it's my pleasure to introduce Sir John Cunliffe for his remarks.
Thanks. Oh, it's like addressing the United Nations, isn't it? So look, first of all, thanks very much to the Fed, to Dave and the team for inviting me here. At midnight on Tuesday, I stopped being a central banker. After 10 years, I turned into a pumpkin. It's Halloween. And so this has given me the chance to say all the things I've wanted to say for the last 10 years and haven't been able to. So it's a great opportunity. It took me several hours, but I'm sure you'll all bear with me. More seriously, this talk is going up on the Bank of England website as well. So, you know, don't feel you have to take notes, or if you miss something that's interesting, or think you just missed everything, you can read it later if you're the sort of sad, boring person that reads central banker speeches over the weekends. But, you know, we're all a bit like that, I guess. Look, it's difficult to overstate, I think, the importance of the announcement by Facebook in June 2019 that it intended to launch a multi-currency stablecoin, a new digital currency called Libra, for those of you that remember that, for general cross-border payment use. Indeed, one commentator, a good friend of mine, Gillian Tett at the Financial Times, has likened the impact of the Libra announcement on central banks to the sudden arrival off Tokyo Harbour in 1853 of the black ships of evil appearance, the fleet, a modern irresistible fleet under Commander Perry, that just led relatively quickly to the collapse of the centuries-old ruling system and the opening up of Japan. And so for the decade before that Libra announcement, central banks and financial regulators had been watching, I think, with quite a wary eye, the development of crypto asset markets using new technologies outside the conventional financial system. And many, like the Bank of England, had dipped a toe into the water of experiments. We ran small experiments with these technologies with just the aim of understanding them better. Some financial firms had gone further, exploring and investing in a limited set of use cases within wholesale financial services for those technologies that seem to be working in what I call the crypto world. And regulators who were increasingly fretful about the cocktail of risks in unregulated crypto asset markets, risks ranging from illicit finance, consumer harms, potentially financial stability, have been debating whether, and if so how, to bring what's loosely called crypto activities within regulatory boundaries. But the Libra announcement and the potential appearance of a new form of money using new technology and moving between countries on new rails outside of the current system galvanized central bankers and regulators into much more urgent action on a number of fronts. So I want to talk today about three of those fronts: the G20 roadmap to improve cross-border payments, the Bank of England's exploration of a digital pound, a central bank digital currency, and the regulation in the UK of systemic payment systems using stablecoins, about which your previous speaker was just talking. So I'll talk about the first, the G20 Cross-Border Payments Initiative, with my CPMI hat on, which Dave mentioned, for the BIS and FSB hat on, but I'll talk about the second, the central bank digital currency, and stablecoins with my Bank of England hat on. I'm giving up both hats, as I said, on midnight on Tuesday, so this really is the last chance for a parting shot. The Libra project, it raised significant regulatory and financial stability concerns, and it led to very swift statements, first the G7 and then the G20, that no global stablecoin project should begin operation until the legal, regulatory and oversight challenges have been adequately addressed. But the project and the benefits that it claimed also shone a light on the cost, speed, reliability and availability of existing cross-border payment systems. And this was a very long neglected and rather dusty corner of the international financial system. Central banks, finance ministries and regulatory authorities, they realized quickly that they could not only focus on the risks that new players and new technologies might bring, they also needed to understand and, if possible, address the shortcomings in the existing less risky systems that just created such business opportunities potentially for new technologies and new players. And there certainly were shortcomings. In contrast to domestic payment systems, cross-border payment systems were and still are clearly slow, expensive and unreliable. And removing frictions in wholesale, retail and remittance payments across borders could not only bring substantive benefits to the world economy, it could also improve access for millions to the international financial system. So in February 2020, very shortly after I took over in the CPMI, G20 finance ministers and governors asked the FSB, the CPMI and other regulatory agencies to develop a roadmap to improve cross-border payments. And initial work by FSB and CPMI revealed that this wasn't a simple problem that was amenable to one or two solutions. It was rather a complex set of interlocking frictions, both in the public and private sector, that were much exacerbated by weak competition in this area. And moreover, while there were common themes, there were clearly substantial variations by region and by payment type. And the CPMI produced a comprehensive list of the necessary action areas, the so-called 19 building blocks necessary to address the problems, covering infrastructure, data, regulation and competition. And these form the basis of the roadmap that G20 leaders adopted at their summit in the autumn of 2020. So 3 years on, I'm about to pass the CPMI baton on to good friend and colleague Fabio Panetta, who will take over as governor of the Banco d'Italia also on the 1st of November. It's fair to ask, well, you know, how well have we done? And what are the priorities for the future? So on the how well we've done, I think we've built a strong, detailed, analytical foundation for the work. For the first 2 years, from 21 through to 22, 23, we produced in CPMI and the FSB a number of reports that analysed those key frictions, also identified in more detail the actions that would be necessary both by the public and the private sector to alleviate them. We set out best practice where it exists and practical guidance on how to make changes in key areas. And equally important, in 2021, the G20 leaders adopted quantitative targets for cost, speed, reliability, covering wholesale, retail and remittance payments to be achieved by 2027. As we all know, what gets measured tends to get done. So equally important was establishing the mechanisms and the data collection that enable us to measure progress towards those targets. And interestingly, across those three areas, wholesale, retail and remittance, there were no good data sets that would actually tell you what the picture was on those key issues of cost, speed, reliability, transparency. The first annual monitoring report against the targets using the new data sets was delivered to the G20 and central bank governors in Marrakesh at their meeting a couple of weeks ago. So while the data are not perfect, and there are important gaps that we're going to need to address in future, we are now able to measure just how far we have to go to hit those targets for 2027. So on the good news side, we've started to see some concrete improvements. Since 2020, a number of countries have expanded access to their payment infrastructures to a wider range of financial institutions, or expanded the operating hours of their payment systems, including central bank operated RTGS systems. Payment systems in more than 100 jurisdictions or already actively using the ISO 20022. If you're in the payments biz, you have to be able to say ISO 20022 without hesitation or stumbling. But that's that's a messaging standard that just allows a lot more data to be carried in the messages, and so it reduces payment fails and actually makes it easier to meet regulatory requirements. And CPMI, working with the private sector, has now developed harmonized standards for using that ISO 20022 messaging system in a consistent way for cross-border payments. Interestingly, though 100 jurisdictions had adopted it, we found out that a number of jurisdictions were implementing it in different ways. So we've actually managed to forestall that by developing harmonized standards. And I think I'd also mention a number of projects, particularly in Asia, that are showing real benefits that can be achieved by interlinking faster payment service systems, which now exist in a number of jurisdictions. However, as the monitoring report shows, we're significantly short of the targets for 2027. In general, on the main targets, we're somewhere between half and 2/3 of the way there. So that's not surprising, given that we're about halfway through, if you like, the roadmap period. But though achievable, given the timescales for investment and other sorts of action like regulatory change, it's a challenging distance that we'll have to travel in the next 4 years. In short, we've built a strong foundation for the work, including quantitative targets and a way of measuring progress. We're starting to see real improvements, but there's a long way to go, and we need continued investment by the public and private sectors in infrastructure, data, and regulatory change to get there. So, as I said at the outset, both the frictions and the actions that we need to alleviate those frictions vary considerably by payment type and by region, but there are some common priority areas on which we'll need to focus in the next phase of the work. So first, we need to see further upgrades of central bank and private sector payment systems to expand access and to extend operating hours. Second, the public and private sectors need to implement the data standards for cross-border ISO 20022 payment messages I just mentioned that we've just developed, and we need to develop similar harmonized standards for application programming interfaces, which is what links nowadays, what enables you to link systems together. Third, we should facilitate and promote the interlinking of faster payment systems. So there's a range of technological solutions available or in prospect, but actually the more you explore these interlinking questions, the problems are not, the obstacles are not primarily technological. They're much more around governance and oversight and how you reach agreement of who sits around the table and who has control of what. The CPMI is doing work in that area, but we need, I think, to set out best practice and, if possible, common principles. There'll be real benefit in doing that to enabling more interlinking projects to come forward. Fourth, we should pursue more effective, coordinated regulatory frameworks for cross-border payments and remove unnecessary regulatory frictions. So a key priority in this area around AML and CTF is the work going on in the Financial Action Task Force to update their recommendation on the misuse of wire transfers. They still use that term, of wire transfers, taking into account the new data standard I mentioned, but also technological advances that may enable more consistent implementation and present unnecessary frictions. And there's a number of other regulatory frictions around banks and non-banks and finality, settlement finality, that regulators need to address. And fifth, we need technical assistance to support the efforts of authorities in low-income regions where actually the performance, as you would imagine, is the worst, to address cross-border payment frictions. And the IMF and the World Bank have an important role to play there, and they're developing technical assistance programs in cooperation with CPMI and the FSB. Finally, competition does work, and we need to enhance competition and innovation, and that means widening access to domestic payment systems beyond banks. And I know that's difficult for a number of jurisdictions for statutory reasons, but I think weak competition is one of the reasons why this area has lagged behind domestic payment systems. And it's perhaps that lack of access to payment rails, which are operated by the incumbents, and the need to use settlement assets or money, which is issued by the incumbents, that actually help stimulate the exploration by potential challengers like Libra of new rails and new settlement assets using new technologies. So the Libra project, of course, after much work and much modification, fell by the wayside last year. The stumbling blocks appear to have been regulatory as much as technical, although there may have been some commercial issues for them. However, though perhaps more muted since Libra disappeared, interest in using new technologies to develop new forms of settlement asset, which, as I say, we can call money, and new payment rails for use in the real economy outside the world of crypto asset markets and crypto asset trading has not gone away. And the recent launch of the PayPal Paxos stablecoin project, which was just mentioned, I think is an example that there is still very much interest in using those technologies to develop new forms of money and new infrastructures to transfer money. And those new technologies, they purport, and I say purport because none of this is proven at the scale necessary to work in the real economy, but they purport to offer improvements in speed, cost and reliability, which will make them very attractive for cross-border use. And exploring their potential is actually part of that G20 roadmap, and actually Dave Mills is leading a lot of that work for the CPMI. But the technologies also purport to offer new functionality for money and payments that may make these competitive for domestic use, even in advanced jurisdictions that have developed quite sophisticated payment systems like the UK, Europe, US. So technological advances have throughout history led to changes in the form of money we use because they've made money easier and just more convenient. So if you think about the shift from physical cash to electronic payments that we've seen over the past decade, it didn't happen because people lost confidence in physical cash issued by the Bank of England or the Fed. It happened because it's just become more convenient to use electronic forms of payment, and physical cash can't be used, of course, for internet commerce. And very small reductions in frictions and very small increases in functionality can mean big shifts, as you see in the shift from using the card itself to using the mobile phone, and for some people to using the wearable like the watch. You don't have to take very much out in terms of a friction to actually induce quite a large change in behavior. So the technologies that are loosely grouped under the broad heading, my staff in the Bank of England hate it when I do this, but I'm going to do it anyway. They've only got a few days to complain. So the technologies that are usually grouped under the broad heading of tokenization, and that word means many different things to many different, it's a very slippery thing, but let's just group them loosely: cryptography, distributed ledger, atomic settlement, blockchain, fractionalization, and programmability, enable new ways of representing money that may allow for greater automation in the way money is transferred, and just a deeper integration of that transfer, the thing we call the payment, into other processes. So what we now see as a separate process called a payment just becomes invisible and integrated into a much broader operation. And while that sort of technology has been pioneered in the crypto asset markets, they could significantly transform everyday payments in the real economy, as I'll discuss in a moment. Now, you can't say with any certainty that it will be possible to deploy those technologies at a scale for general use in the economy, or that users will actually value and adopt the new functionalities. But it seems very unwise, in my view, to bet, as some people seem to be prepared to bet, that we've reached the end of developments in money and payments. And that brings me to the other two areas of action that were accelerated by the announcement of the Libra project 4 years ago: the exploration of central bank digital currencies and the regulation of private sector firms that propose to use those technologies in some way to create new forms of money like stablecoins and new payment systems for general use in the real economy. So first I'm going to say a little about where we are in the UK on the possibility of introducing a CBDC, which we've called the digital pound. In February this year, the Bank of England and the Treasury, so the Finance Ministry and the Central Bank, issued a consultation paper on the design of a digital pound. And the consultation paper didn't propose that we introduce a digital pound in the UK. No decision has been taken to do that. Rather, the paper concluded that on current trends in money and payment and technological advances, the trends I've just been discussing, those trends made it likely that a digital pound would be needed by the end of the decade, and the paper set out and invited comments on a detailed model for the digital pound, which we propose to explore and test in the next stage of our work prior to a decision in 2 or 3 years' time on whether or not to implement. And the model we proposed was one that a number of central banks have been looking at, where the Bank of England would provide the digital pound, the money, and the central infrastructure in such a way that private sector firms could be the interface with the user, offering wallets and programmable payment services. And the consultation paper offered 2 main motivations for the possible future introduction of the digital pound from a public policy perspective. The first, and this is the most relevant to central banks, concerns the role played by state money, i.e. money issued by the central bank to the general public, in anchoring confidence in money and supporting the singleness of money, in other words, the interchangeability of all monies, public and private, that circulate in the economy, on demand and at par value. The only form of state money available to the public at present is physical cash, and it's declining in its use and its usability. It's declining particularly fast in the UK, I think. 10 years ago, it was over 60% of transactions with physical cash. I think last year it's got to be 14%. So that's a pretty fast decline. It's been seen in other European countries. And as the Libra project highlighted, new non-bank players could potentially exploit the technological advances that I'll be talking about to offer new forms of money and new payment systems and services. And against that background, my view is that it's likely to be necessary to issue central bank money in digital form to support confidence in money, particularly in stress, and to ensure the singleness of money. There are other things we do to ensure the singleness of money and confidence through regulation and through settling across central bank books. But actually, 1/3 pillar of that is the availability to the public of state money in a form that they can access every time they, at will. They can change private money for public money by just going to an ATM machine. The second motivation, public policy motivation, concerns competition and innovation. So this is more for governments than for central banks, but we have an interest in it as well. Digital marketplaces have a tendency to concentration, as I think we've seen with digital platforms over the last 10 and 15 years. And that can be a barrier to competition and innovation, with the risks that new entrants would be tied to private issuers of digital money and their payment systems. So if you think apps and app stores, if these developments take off in the private sector, we could see barriers to competition and innovation, and particularly true, that will be particularly true if big tech firms enter into the world of money and payments, and they're all skirting around that world. I think Facebook, Meta made their attempt and they've withdrawn, but there is still interest, I think, in being involved in money and payments for a variety of reasons on the part of the different big techs. So competition and innovation may therefore be enhanced by providing a public alternative, a public digital money platform in a form that would allow private firms to offer services exploiting the new functionalities that I mentioned. Our consultation paper received over 50,000 responses. So we normally get 4,000 or 5,000 responses from financial firms. We got 50,000 responses, and they fall into 2 broad categories. The majority expressed general high-level concerns about 3 broad issues: privacy, programmability, and continued access to physical cash. And the second set of responses were detailed comments on the platform model of a digital pound that we set out. So we expect to publish a detailed response to the consultation in the coming months. I'm going to read it with interest, addressing both types of response to the consultation. And I don't want to anticipate that, but it is possible to make a few observations. On the first category of response, our consultation document made clear that under the proposed model, neither the government nor the Bank of England would see individuals' data. Rather, private sector payment firms would be the interface with the user, handling user information in the way that banks handle user information and transaction records and card companies today. Users would have at least the same level of privacy and protection of their privacy that they enjoy today when they're making electronic payments. We also made a commitment that neither government nor the bank would program the digital pound to constrain its use in different ways. It's interesting here, I think the discussion has been whether a central bank digital currency could be used to stop people buying guns. In the UK, it was more about stopping people buying sugar. We're different societies. But concerns that government would program money so that you can't use it in certain ways. So it would be for private sector firms to develop and offer, with user consent, payment services involving greater programmability and automation of payments that I talked about earlier. And as regards cash, the UK government recently legislated to ensure the continued availability of cash, and the Bank of England has made it clear that we'll provide physical cash as long as there is any demand for it, and there will probably be demand for it for decades, because I think for some parts of society it will remain a very important settlement asset. The responses to the consultation illustrate the importance of those issues in the public mind, and it's clear that public confidence in our approach to those issues will be essential if a future decision were to be taken to introduce the digital pound. So during the design stage, we'll develop the strongest possible protections in these areas, and the government has committed to introducing primary legislation before introducing a digital pound. On the second type of response, there's general support for the so-called platform model that we proposed, but there were different views on some of the key aspects, particularly the limits that we propose should apply, at least initially, to prevent rapid destabilizing changes to the banking system that could have financial stability implications. Some fintechs, merchants, question the need for limits, while banks in particular, and not surprisingly, are concerned about the impact of the digital pound, a central bank digital currency, on their deposit bases and on financial stability. And on the question of use cases, again, different views. Merchants, fintechs, payment service firms appear supportive of the possibility of generating new use cases for a retail digital currency, but others, particularly banks, are more skeptical that attractive use cases will be developed for a retail digital pound. So we're still in the process of a detailed analysis of all of those responses, and as I say, the bank will respond comprehensively in the coming months. I'd only observe a little bit tongue-in-cheek, seeing as I'm going, that the criticisms of the digital pound have ranged from concerns that it would be adopted at a scale and speed that would disintermediate the banking system and create financial stability problems, while at the same time, and sometimes by the same people, concerns that there's no use for it and it will be a solution looking for a problem. So, not surprisingly, as an institution that's charged with financial stability, the clue is in the name, my post is the Deputy Governor for Financial Stability, we take the first point very seriously indeed. Modelled estimates that we published a couple of years ago suggest that even with a very high level of take-up, the impact over time on the banking system should be manageable. Other central banks have done similar work and come to very similar conclusions. But those can only be estimates. You can't know in advance what the behavioural responses of users to a digital pound, i.e. the speed, the scale of take-up by households and firms might be. And that's why we proposed, initially at any rate, that were we to introduce a digital pound, there would need to be limits on holdings. And during the next phase of development, and in advance of any decision on whether or not to go ahead and launch one, we'll refine the calibration of those limits further. The second concern about the use case, or is there a use case, I think, to be honest, misses or risks missing the point. I'm reminded a little of Henry Ford, great American, who's reported to have said that if he'd asked people what innovation they wanted, they'd have said they wanted faster horses. Were we to decide to introduce the digital pound, the objective wouldn't be to target some particular failing or some use case that is kind of missing in current payment systems. Rather, the objective will be to create a public sector platform using a public sector settlement asset, public sector money, that private payment services firms could use to exploit those greater functionalities, if they exist in money and payments, that technology may now offer in an increasingly digitalized world. So experimentation that we carried out with a variety of private sector firms, from payment service firms, internet platforms, fintechs, a bank was involved, on a platform that developed by the Bank of England and the Innovation Hub of the Bank for International Settlements, provides some initial support for the view that with a relatively small number, 3 or 4, of technical features, a digital pound could support a very wide range of new payment use cases. While it may be possible, and for those of you that are interested, I mean, it was called Project Rosalind. There are some examples of this in the published, I won't go through them here, in the published version of the speech, but actually all of the outputs from Project Rosalind are on the Bank of England and the Bank for International website, Innovation Hub website, if you want to look at the use cases. Some of them were quite humorous, some of them were pretty innovative, but it was by just providing some simple programmability features, it was possible for a kind of general settlement asset to be used for a very wide range of different experiments in use cases. And while it might be possible to deliver some of the use cases through specific programming of existing payment systems using commercial bank money, what the project showed is there's clearly material advantages in a general purpose platform using a general purpose settlement asset that can be used, programmed, configured relatively simply, consistently and cheaply for a broad range of use cases. And I come back to that point about quite small frictions can make quite a big change if you remove them in the sort of innovation and the scale of innovation that you get. So in the next phase of the work, we'll work more intensely with the private sector to explore possible use cases for the digital pound and the technological design necessary to create the best platform for innovation. At the same time, with the Treasury, we'll consult more widely and conduct what my finance ministry colleagues call a national conversation on some of the key features of the digital pound. So, of course, it will be possible for the private sector to use those technologies to create new infrastructures and issue private money for general use in the economy. And as I started, that indeed was precisely what the Libra project proposed to do. Initially multi-currency, and then it was going to be a US dollar stablecoin. And that brings me to the third front on which Libra galvanized action, the development of international standards and domestic regulatory frameworks for stablecoins. So in 2022, CPMI OSCO, which I co-chair with, now with Russ Benham of the CFTC, the international standard setting body for payment systems and market infrastructures, issued guidance on the application to stablecoins of the international standards for systemic payment system. And in much the same way and to much the same effect, the Financial Stability Board issued high-level recommendations on global stablecoins in 2023. Both effectively set standards for some of the unique features of payment systems using stablecoins, including not just the mechanism for the transfer of the coins, but also the requirements for the coin holder to have a clear claim on the issuer and the need for the issuer to be able to repay that claim when requested in fiat money at par value by the end of the day. So very similar standard that we expect of commercial bank money. International standards take a long time to develop, believe me, but they're only effective if they're implemented by national jurisdictions in legislation, and many jurisdictions, not least of all here in the United States, are currently wrestling with the question of how or whether to extend their regulatory regimes to stablecoins and more generally to crypto assets. So some jurisdictions, however, have legislated to bring stablecoins used for payment within the regulatory framework. In the UK, Parliament passed legislation just before the summer that gave the Bank of England the power to regulate systemic payment systems using stablecoins, which extended the powers we already have to regulate existing systemic payment systems. And we expect soon, very soon, to issue a discussion paper setting out the proposed regulatory regime in detail for such systemic retail payment systems using stablecoins. And I can't actually set it out in detail today. You'll have to wait for the announcement. But I would like to explain how we've approached some of the key issues and, if you like, policy issues and design choices in that regulatory framework, and how we think that regulatory framework for payment systems using stablecoin should fit alongside other regulatory regimes within the financial sector. So first and most obviously is the question of why. So do we really need new forms of money issued by new players moving on new payment rails? And that's essentially the same question that I discussed earlier in the context of the digital pound? And much of the answer is the same. While it's not certain that these new technologies will actually deliver the innovation and competition in payment services some people claim, we don't want to prevent that innovation either, provided, and this is a really big provided, the risk can be managed to the same degree as equivalent risks are managed both for existing payment systems and existing commercial bank money, which is used as the main settlement asset. And there may be some players who will attempt to operate outside the regulatory boundaries, but setting out clearly the regulatory framework enables those players who wish to innovate sustainably and responsibly to build the necessary management of risk into their business models and into their technology. Second, as I've said, our approach is to ensure that the risks are managed to the same degree as equivalent risks are managed for existing payment systems and the private commercial banks who issue the money that's transferred in payment systems. And that's an important elaboration of the fundamental regulatory principle of same risk, same regulation. It may not be possible for technological or other reasons to apply the current regulation for systemic payment systems and the regulation of commercial bank money to payment systems using stablecoin. So as an example, it will be impossible to provide collective deposit insurance akin to bank deposit protection, initially at any rate, because unlike for banks, there's no broader industry amongst which to share the costs of a payout. So in order to achieve the necessary level of protection of the coin holder's claim, and so protection in systemic terms against run risk, there'll need to be more robust requirements in other areas to get to the point of same regulatory outcome if the same risk is being run. And that will cover particularly, but not exclusively, the requirements for the backing assets for a stablecoin that will be used in a systemic payment system. And in that respect, the Financial Policy Committee of the bank judged in 2022 that the backing assets should be either extremely high quality liquid assets or either in the form of deposits at the central bank, so central bank reserves to back a stablecoin, or in the form of very, very liquid government securities. The lack of deposit protection also has implications for the nature and the enforceability of the coin holder's claim. Third, we will require a legal entity that can be identified as the payment system operator and held responsible for the end-to-end management of risks. Stablecoin payment systems can be structured in very many different ways, including arrangements where the issuance of the coin, the transfer of the coin, the storage of the coin, otherwise known as the wallets, are all performed by separate entities. It's not clear that use of public permissionless transfer mechanisms like the permissionless blockchain would be consistent, certainly with current technology, would be consistent with this requirement for a legal entity to be held responsible for end-to-end risk management. But our regime will be designed to be flexible and accommodate different structures insofar as that can be achieved with the necessary management of risks. Fourth, as with the digital pound, we can't know the behavioural response, the speed and scale of adoption of new forms of money and payments. We therefore need to be alive to possible financial stability risks from a rapid transition to stablecoin payment systems that could impact the stability of the banking system. For the digital pound, we propose limits, initially at any rate, to manage that risk, and it would make sense to take a similar approach to stablecoins. And finally, and perhaps kind of most importantly, we'll aim to ensure clarity on regulatory boundaries and the business models, clarity on the business models that fit within the different regulatory regimes. So the proposed regulatory regime is a payment system regime, and the public policy motivation is to enable innovation in payments. It's intended for business models that are focused on generating revenues from payment services. Business models that are more focused on earning revenues from maturity and liquidity transformation, the return on the assets backing the liquid-like money claims they issue, pose risks that are more appropriately regulated within the banking regime. Likewise, business models that use stablecoins to represent claims on investment products like money market funds, which do not guarantee redemption at par, are simply not suitable for use as a settlement asset, as money in systemic payment systems, and those need to be regulated under an investment regime. Innovation using new technology is not being confined to new entrants, so banks, whose business model depends in part on issuing liquid liabilities in the form of bank deposits for payments, may well want to use the new technologies I've been talking about to tokenize and transfer bank deposits. And that would fall, in our view, under the existing banking regime rather than under the proposed regime for payment systems using stablecoins. There are a number of issues concerning the issuance and transfer of bank deposits in tokenized form that will need to be considered by banks and by bank regulators, including the important question of whether such tokens should be permitted to circulate freely like some form of digital banknote, or whether they should always be tied to a bank account and operate through the adjustment of existing bank ledgers. But the underlying nature of the claim, deposit protection, in fact, the management of risk should be regulated under the banking regime. Banks may also want to issue stablecoins under the new regime we propose for systemic payment systems using stablecoin. In our view, if they want to do that, that needs to be issued out of a separate bankruptcy remote legal entity with different branding to avoid confusion among consumers and contagion in a stress between different forms of money. And we will set all of that out when we publish our discussion paper. So to conclude, sorry it's gone on a long time, but it is 10 years worth of stuff to say. I'm often asked, what do central banks do? Or a more penetrating question I get, and this is usually from school children, is what's the Bank of England for? Okay, so that's a difficult question. So rather than give them the long list of Bank of England functions, monetary policy, financial stability, bank regulation, payment system regulation, provision of cash, I'll give a much simpler answer. Central banks' responsibility, that most foundational element of not just the economy but society, the thing that we call money, works, okay? That people can use it every day with confidence in its value, confidence in its creditworthiness, in its authenticity, confidence that it will be accepted everywhere at the same value in whatever form it takes. And while we might not be the originators of technological innovation in money and payments, we do, I think, have a responsibility to ensure that beneficial innovation that improves the usability and functionality of money can not only happen, but can happen without putting confidence in money at risk. So one cannot know, I can't know whether the appearance of Libra off the shore of conventional money and payments 4 years ago was truly a black ship's moment. I certainly hope that the wake-up call it gave us to improve cross-border payments is not forgotten, and we deliver the long overdue improvements that the G20 has set as the targets. Likewise, while I think that on current trends, the digital pound in the form we proposed is likely to be needed around the end of the decade, the picture may look very different in 2 or 3 years' time when the decision is due to be taken. And stablecoins and their associated technological innovations may never cross over at any scale from the highly speculative world of crypto asset trading to the real economy. But to be able to make sure that forms of money and the means of transferring them can evolve without putting that essential confidence at risk, central banks, in my view, and as the Libra moment reminded us, need to look to the future and they need to prepare for it. So thank you for giving me the opportunity for this parting shot. Okay. All right. Okay. And I think I'm down to, if I've got any time left, I'm down to take questions, but very happy to do that. But.
Yeah, sure. I think we do have a few minutes for questions, if there are any from the audience.
I guess given you're in a position to give parting shots, maybe I'll ask a slightly more controversial question. In some sense, I kind of think about the future paths that you describe with Libra and otherwise as we're choosing between a future in which we are dominated by big tech, big banks, or big central bank. And I guess the question is a little bit of how do you think about the kind of relative costs and benefits of these options? In the sense that in kind of many settings of our economy, some of the most competitive sectors are the ones in which we have really large platforms. So if we think about retail, if we think about, say, media, I think a lot of the new entrants are platforms. And I think finance is rather unique in the absence of large platforms, even within countries, and especially across countries. And so I guess, I'd be curious to kind of hear your thinking about the weighing of why, or kind of the relative costs and benefits of these future potential paths that we're contemplating.
So first, I don't know how the future will develop. So what we've gone for, to some extent, is optionality. And I don't see the digital pound as being designed to destroy commercial bank money, which I think will be around for a long time, nor to block stable. Some people say, well, you're doing this to stop stablecoins. I think we have a mixed ecosystem in money at the moment. We've got 800 issuers of private money in the UK. People get upset when I tell them that, but it's true. And I would expect, we have e-money, which I didn't talk about. So I expect basically competition and different forms of money to evolve. So it's not a choice for me between the two. I think big tech platforms can bring economies of scale and scope and efficiencies, but they can also block competition. And if you look at some of what's been happening in recent years as competition authorities have tried to retrofit competition, privacy, and other regulation on platforms that have already evolved, and the lesson I take for that is not that good platforms are big platforms are good or bad, but waiting until they're established at scale and then trying to regulate for public policy purposes it creates huge difficulties once something has been adopted at scale. So I think we should set out the regulatory frameworks, and my guess is, I don't know if big techs will come back again and be interested in stablecoin. I don't think they'll be interested in taking a return on the assets. They'd be much more interested in locking people into their platforms because that's their business model. Provided there is an alternative that a payment system developer who wants to automate a payment in a particular way and offer a service can do without being constrained to use the platform or without being constrained to use the money that the platform issues. And I think if you provide that public sector alternative, it may not be used very much, but actually you anchor the whole system and you anchor competition. So it's not for me a question of either or. It's a question of ensuring that whichever way this goes, we've thought about it, we've prepared for it, and the people who want to do it responsibly kind of know what they have to manage when they develop it.
The use of or the implementation of a CBDC would increase the attack surface for cyber criminals.
Yep.
So that being the case, what ways does the Bank of England see to improve and measure the resilience of such a system if it is implemented?
We set out, there's a technological working paper that's attached to the discussion paper, and we set out some requirements, or certainly for operational stability, and then particularly around this question of cyber. The development will be done with the national cyber prevention authorities. That's one of the advantages of working with the government and the central bank kind of working together. So we'll be working together with them. The attack surface is pretty big on private sector payment platforms at the moment, if you think about how many payments go through electronic payments and cross-border as well. But I can't tell you what mechanisms will be used. We'd only implement it, I think, if the authorities responsible for cyber and cyber protection thought we got it to the stage where we need to get it to. Have to say, though, those authorities are also working with us on the supervision of systemic payment systems, which suffer the same risks. Oh, there's a chap at the back, I think, who was actually first, but...
So you mentioned the decline in cash use for transactions in the UK. How much of that is the result of the spread of instant payments, and how much is older forms of electronic payments?
So most of it is to do with the spread of card payments. The UK is unusual in that I think we invented faster payment systems back in the early 2000s, and then never went on to develop them for point of sale because I think the banks and the card companies preferred to operate through the card system. So most electronic payments happen in the UK through debit cards, some through credit cards. You can't use faster payment systems for point of sale in the UK at the moment, unlike other countries like Sweden or the like. I think the decline of cash is down to a number of things. some of which is to do with public sector regulation. So the European Union, while we were still a part of it, legislated to control the interchange fees that the card companies charged. So that brought down the cost. That hasn't happened in the US. I know it was an issue in Congress a few years ago, and there's one particular amendment sort of went backwards and forwards, but I don't think it was ever achieved. So I think in the UK, I need to get this right before I'm sued by card companies, but large firms will pay sort of 25, 30 basis points, for a debit card transaction. Small merchants, though, can face costs of 150 basis points or more. I think in the US, it's a multiple of that for many. So economic regulation, and the UK is unusual in that the government set up an economic regulator of payment systems designed to enhance competition, the payment system regulator, about 10 years ago. So some of it is to do with reducing the costs. And of course, the costs of cash are there: insurance, security, bank accounts. I think a lot of it is to do with internet commerce. But some of it comes back to small friction. So contactless came into the UK, I'm trying to think, it may have been about 2010, 2011, the contactless use of cards. But it didn't really take off until things like in London, the transport system, the London Underground, suddenly allowed you to tap your card and it would just tap it at the other end and it would deduct the fare. Once that happened, you suddenly started to see a lot more usage. It's little things just make the difference. So many shops around in the city or whatever don't take or prefer not to take cash because they don't have to deal with any cash handling problems. And of course, people are more used on the internet to paying. You need a transactional bank account, a checking account, I think you call it over here, to internet commerce. So all those kind of things, cost, convenience, have come together. And then, of course, mobile phone wallets and watches develop, and suddenly a number of people, just a little friction of taking the card out of your wallet because you're holding your phone in your hand, because we all walk around holding our phones in our hands, just that little friction kind of shifts things into the wallet. And you talk to some of the hardware providers like Apple or whatever, their objective is to make everything happen in that wallet just by increasing its functionality and convenience. It's a variety of things coming together. So, sorry, there was a question. Yeah.
So it seems that many benefits of central bank digital currencies can be achieved by creating instant payment system and then making it available to all banks in the system and making it person to person. So examples from China and Nigeria show that people don't really use CBDC because they already have advanced payment systems. Why do you think central banks still discuss central bank digital currencies despite the risk associated with them? For example, Central Bank of Brazil, although they have PIX, they still discuss potential...
Well, they're developing one. They're developing one.
Yeah, exactly.
They're not discussing, they're developing, as is India. So there's a couple of important distinctions in that question. So I'm not sure what you mean. So some of the developments of central bank digital currencies, and the one a lot of banks in the UK would prefer, is that we issue a tokenized central bank currency to the banks, and the banks issue a tokenized deposit for use in these programs to their consumers, rather than we issue it directly. And you can understand why the banking system might prefer that model. Just as an aside, by the way, and this is, it goes in the kind of 10-year bucket of things you want to get off your chest. When I grew up, over 70% of payments in the economy were physical cash. My first pay packet was a little brown envelope with physical cash. That's what we used. I was told when I tried to open my first bank account at university, I'm very old, my first bank account at university, it was a privilege to have a bank account. And basically all I used it for was to withdraw physical cash because that's what I needed. So this huge shift to transactional accounts for everyday transactions or whatever is something that's happened certainly within my lifetime and actually within my adult lifetime. So the idea that somewhere in Deuteronomy it's written, that this is the model of the banking system we have and we can't disturb it, is something I don't subscribe to. I think banks adjust, they find new business models, they've adjusted very well to electronic payments, and it's worked quite well for them. I don't feel as a central banker I have a remit to defend a particular business model. I have a remit to prevent risks. So what could this thing do? So I'll give you an example from Project Rosalind, which is, I use it sometimes in the UK. We have train strikes in the UK, we have industrial action, so this kind of resonates. it is possible with the little platform that we developed with the Innovation Hub, with just a couple of programmable features in the settlement asset, to integrate the buying of a train ticket, and then a particular train ticket, a train leaving at a certain time, and the automatic refund if the train didn't leave the station at time back to your wallet. So you could say, well, I could do that now because I can do standing orders, and I can. But when you think of what happens behind a credit card payment, which is using a faster payment system or whatever, just the number of ledgers in the system that need to be adjusted, all of the programming, the answer is you could do it now, but the cost of doing that is quite high, and you would have to do it in a different way for a different use case. And if you have a general purpose asset that can be configured, I was actually surprised in Project Rosalind how few the features were. Things like hash time lock so that you could lock the funds, how few the features were. So it may be, so I'm not a technologist, and they all tell me different things. It may well be, well, they're like economists, but it may well be that you can do all of those things in the existing system by adjusting all of the existing ledgers through APIs. And there's a school of thought that says we just need to link things up together. We can use application programming interfaces to make them talk to each other. We can adjust all the different ledgers, the merchant's ledger, the card acquirer, you know, with the instructions coming from the card company or whatever, or through a faster payment engine. I suspect that the little frictions that I talked about are what stops that from happening. I don't know if it's true. As I say, it may be that these technologies never quite deliver. When I look at some of the things that happen in that Wild West called the crypto world, where they do use some of these things without controls and without risks, without controls and with some very old risks, as we see in some cases, they do manage to automate the transfer of value that is the payment much more deeply into other processes. So I don't know, but if it happens and starts to happen at scale, I want it to happen with developers who say, okay, you know, I need to think about my business model, where do I make my money, what are the protections for the coin holder, rather than try and retrofit all that afterwards. Yeah, please. Yeah, so, yeah.
Hi. So I have a question like related to retail central bank digital currency, and especially thinking of different countries potentially using a slightly different system. So when physical cash, it has kind of similar features everywhere, but chances are that maybe ECB and Bank of England do not have the same preferences for programmability and privacy, for example. Then what do you think is a problem or potential solution for this?
So I think interoperability between different retail CBDCs, between countries, you mean?
Or it is also like just a core feature. So suppose, I mean, are you worried, for example, that one major central bank does something faster than Bank of England, and then it kind of sets a standard that is not considered to be the best one according to Bank of England, or like any other combination?
Yeah, so you need to step back one and say, we're still thinking as central banks, and as part of this project, it's part of the CPMI work that I talked about, just how much interoperability we want, because there are benefits and costs to interoperability on retail, and what level, how deeply the systems need to be using the same technology, or go back to what I talked about, APIs. So that discussion, and actually some work being done again by Dave on at what point in the development of a CBDC do you start to close down options about how it might talk to other systems. On the question of will somebody win the race and set the standards, I think it goes into two different bits. I think and there's kind of governance and policy standards and technical standards. I think some of the course technical standards, the way it operates, the way it integrates with domestic payment systems, will be essentially domestic, and you wouldn't use a technology that didn't work in your financial system with those structures. But there are some common things around messaging standards, some of them which go just to the internet in general, not just to financial services, where I think there is an issue about ensuring the standards that would be necessary for the transmission of money in these forms are developed in a more collective way. So there is an issue there. It's not deep in the kind of do I use a blockchain or do I use a distributed database? But it is when I start to send messages through the internet, money attached to an email or whatever, then I get into much more general standards. And there I think we are going to need some work to bring them together.
So I think we have time for one more question. I understand it's right next to me.
So, Sir John, I think I have perhaps the most important question of the day. Congratulations on your retirement, and thank you for coming to speak here today. As you move into your retirement, I suspect that you'll have lots of time to do things like watch football.
Yeah.
And so my question is, what do you think the prospects are for Arsenal in the Premier League this year?
Okay. So first I need to issue a correction. I'm finishing my term at the Bank of England. I haven't decided whether to retire or not. So it's an important, for me, it's an important distinction. I think they're better than they have been for many years. But I still think Manchester City has got the depth of squad that will, in the end, get them there. If, and this is the kind of why we watch soccer. I don't know what will happen to injuries and important players, so it's difficult to know. But I think we've got a better chance than we've certainly had for 20 years, and I'm very excited about it. I don't know how many of you watch British soccer, but I recommend it if you don't.
Well, on that note,
Okay.
Thank you very much.
Okay.